Hey, it's Jonathan. Thanks for joining me today. I hope this video finds you in good fortune. Today I want to continue on our fundamental analysis. We're going to talk about economic reports. Today we're talking about the PMI, the Purchase Managers Index. I'm going to give an overview of what it is. We're going to look at the numbers that were just released for the PMI, and we're going to show a little bit of divergence. I'm going to explain a little bit of divergence that we see in the market right now, why the indicator is not basically going in the same direction that the market is moving, and I'll explain why and how we need to look at this in the future, considering economic boom and bust cycles, and what to look for and how to prepare for both. We're going to talk about the economic boom and bust cycle as well a little bit, but we're also going to try to make it brief. So let's go ahead and take a look at this. Okay, so overview of what the PMI is. What is the PMI? It's a Purchasing Managers Index. Okay, the PMI is released once a month. The PMI is a very important indicator. It usually creates a move in the market, so is something that we need to watch. The report is broken into three parts. You have the Service PMI, which looks at services, the manufacturing, and the Composite PMI, which is a combination of the two. The PMI, what the report can basically consist of is the PMI is Purchase Managers Index. It asks a bunch of purchasing managers different numbers about whether they're going to place new orders, if there's any price changes, employment, if there's changes in the whether they're hiring or not, if they're going to let people go, quantities of purchases. So basically it just gauges the health of the business by asking them, are their numbers greater than last month or less than last month in these different categories. And actually there's a whole list of categories. We'll talk about that. I'll show you another report that some of these numbers come from. Is a couple of people that release these reports. In fact, it's right in here in these notes that I made. We'll get down to it. Okay, so the purchase managers are asked if their current numbers are above or below or the same as previous months. Um, this gives us a PMI indicator. Results above 50 are the result of expanding economies. Results below 50 are the constriction of economies, and basically 50 is neutral, so when it doesn't change. The manufacturing PMI is a great indicator to forewarn you of the economic changes, as manufacturers are more susceptible to price changes in goods and services. So the manufacturer PMI is a real good indicator of where things are going. The businesses need to prepare. If you're a cereal business, you make cereal, and you see the price of grains going up, then you're going to start trying to hedge for that price increase. There's a couple sources of PMI data. There's a company called Markit, spelled with a KIT. So Markit, it focuses on companies on American soil. The ISM is a good PMI source for tracking multinational companies. Typically, when you're looking at the global PMI, when global PMI goes down, when the world goes into a recession, when the globe goes into recession in general, the U.S. dollar will appreciate. This is just something that I've noticed, and I just thought I'd throw it in here. So that's something to keep. We've seen a gigantic boom in the U.S. dollar here recently, and it's just something to keep your eye on. Markets can be evaluated as moving in economic cycles, boom and bust, expansion and contraction. Okay, so what I want to do is I want to go. We're slowly adding to the website. We're building out our features and adding to our content. And this is a learning section on the website. A couple of charts that I thought would be very helpful. This is something that I reference all the time. And to see where we're at, this basically gives a overview of market cycles. But you can find this on our website. I will put a link to it. And so markets can be evaluated as moving in cycles, boom and bust, expansion and contraction. And you see here, let's see if I can make it a little bit bigger and slide it over. So this basically just gives us our cycles, our market cycles. So you have stocks and commodities going down, commodities going down. This is as the market's moving into a recession. And then I wonder why my cursor's not showing up like it should be. Anyway, so we have bonds, stocks going up. The stocks, bonds, and commodities going up. This is when we start going back into a expansion phase. At that point, bonds will start going down. Stocks and bonds will start going down. Commodities will start going up. Stocks, bonds, and commodities go down. So on and on. You'll see the cycles here. This is something that you might want to hop on the website. It's there available for you if you want to take a look at it. Now this was actually pulled from interpreting PMI data, and that's from the market group that actually releases the PMI data. This is their version of the market cycle. I changed it a little bit because it makes more sense this way. So I changed the way that their graphic looks. But let's take a look at what's going on here. You can see that interest rates fall. So when interest rates fall, economic growth is stimulated. Increased employment and demand for new raw materials happens. Skill shortages and supply problems develop because there's so much demand. So too much money chasing too few goods. Staff wages, raw material prices rise. Inflation picks up as higher costs and are passed on to the customer. So then you see the inflation like we have right now. Interest rates rise. So the interest rates have been rising. Economic growth slows. We have a slowdown in the economy. Interest rates fall. So we're back right at the beginning. Interest rates fall. Economic growth is stimulated. This is a brief description taken from their paper. It helps to first consider the typical pattern of events in a classic boom-bust business cycle. During a period of economic expansion, it is typical for employment to rise, unemployment to fall, and the demand for raw materials to increase. If unemployment and demand for raw materials rise at suitable fast rate, it is then common for skill shortages and supply chain bottlenecks to develop. It won't let me scroll up. Let's see. Make this big. When demand exceeds supply, prices, so we're right here. When demand exceeds supply, prices tend to rise. Wages, salaries, raw materials prices will therefore begin to increase. Retail prices inflation may then pick up as higher costs are passed on to the consumer. The standard economic policy prescription for rising inflation is an increase in central bank base rate, which will also increase borrowing costs to businesses and the consumer. So we see that happen as interest rates have risen. Now the interest rate of everything's going up to buy property, and we're starting to see effects in the housing market where the interest rates are going up, the housing market's slowing. Also, the automotive, which I think we're going to probably have a bubble in, used cars. The used car sales are going way down, and I think we're getting ready to see a major contraction, or even a bubble pop in the automotive industry. It's something to look at right now. So costs to businesses are passed on to consumers. Decreasing the demand, prices and economic growth then tend to grow at a slower rate. When demand has slowed sufficiently, interest rates may be lowered again, thus stimulating the economic growth. Okay, so you can find the article that this came from right here at the Interpreting the PMI data. This is there's a link to it right there on the website. So this is yeah, the link is right. Let's see. There's the link to it right there. But okay, so this is the paper and this is the excerpt that came from it. There's a lot of good information in here. If you want to take the time to look at this, this is a very good paper explaining exactly what the Purchase Managers Index is. Okay, look, so Purchase Managers Index, the numbers were just released. So remember, 50 is our line where it stays the same. This is the Forex calendar that we've been using at Forex Factory. So this is based off of 50%. Everything over 50% is a positive number, expansion of the economy. Everything under 50 is a contraction of the economy. So our numbers were 46.6 and 49.9. So we see a contraction of the economy. Now, this would normally mean that the stock market and different markets would go down because there's a contraction of the economy. So levels of diffusion index based on survey purchasing managers in the service industry. Actual greater than forecast is good for the economy. So if it's greater than the forecast, it's good for the economy, which we see it was lower than the forecast right here. So let me show you what happened to the market. So this should actually have made the market go down, but because we're in it's because there's high inflation and we're basically in a bear cycle in the market. That's not what's happened. So this was the market yesterday. You actually see the market going up here, even going into the release of the report. You see the market having a little rally there. Now, whether this will continue or not, I'm not sure. Again, we are in general in a bear market, but when you're in a bear market and we have high inflation, what we want to see is negative numbers. The more negative numbers, then that indicates that the inflation will eventually come down. So people are buying into these negative numbers instead of selling into the negative numbers. People are buying into the negative numbers. This is the S&P 500. If you look across the markets in general, you'll see the same thing. So you can obviously see that we're having a downturn in the market, but my point is that whether the market goes up or down on these indicators is not necessarily based off of the number. It's based off of what's going on in the economy at the time. Uh, General Chairman Powell is looking for lower employment numbers or higher unemployment numbers and a turn down in the economy, the things slowing to see that inflation number come down. So what we want to see is here's unemployment claims. This is one we're going to be looking at that I'll do a video on. We want to see unemployment claims go up because that means less people at work, less money in the market. And but the PMI is just a good indication of a slowdown in the economy. So you see these numbers slowing, that therefore people are purchasing and buying into some of these higher risk assets like the S&P 500 and things like that. So because we see that possibly interest rates will come down, that'll have a weakening dollar, which will put more money back into high risk assets. So. Okay, that's about what I have for you today. If you have any questions, just comment on this post. Comment on the post anyway. It'll help it get spread around. I hope you found this information useful. If if you have any questions, just put them down there. Give me a like, subscribe, all that kind of stuff. I really do appreciate it. And y'all are beautiful. I'll see you next time.